Hi everyone, Heinrich here from Lightbulb Wealth Management, and I wanted to do a quick Q&A session with you today. I've had a number of inquiries, substantial inquiries from prospective new clients that have been reaching out to us who have been finding themselves in a very difficult situation over the last few weeks, both in terms of concerns they have over their superannuation portfolios, retirement plans, questions around how to navigate through meeting their debt obligations on investment property loans, mortgage repayments on their owner-occupied home, and just some other general questions. So I thought it might be helpful to try and answer some of those questions in the Q&A video. So I thought I'll do this one today, and I've got quite a lot of questions. Won't be able to get through all of them, but I thought we'll do one today. That's been a regular question coming through, and then the other questions we'll do in further Q&A sessions. So today is Monday the 30th of March 2020, and before I launch into the first question, just an important note to let you know that this video is general advice only and does not take into consideration your personal financial objectives, financial situation or needs, and you should always arrange and speak to a professional advisor in relation to financial advice, legal, credit and or taxation advice prior to acting on any information that may be contained in this video. So let's get into the first question, which is, Heinrich, what impact would a recession have on share portfolios and on property values? So really good question. The short answer is that in the short term, there's definitely an impact there. What we can see from the data dating back to 1900, so over the last 120 years, if we look at all the different bear markets that have taken place, and a bear market being defined as a 20% drop in the value of shares, where those share prices do not recover in a 12-month period, then what we can see is that there have been 18 occasions in the last 120 years where we've been in a bear market. What we can see from the data is that each bear market on average lasts for about 18 months, and the decline or loss of value in shares is approximately on average 30%. So that is just the history of how long these things can last for and the impact to portfolios. In terms of real estate, what we've seen in regards to crises that have happened over the last, say, 40 odd years, real estate holds up actually quite well. The volatility is very different to shares. It's not as volatile. And the decline in real estate values is far less, typically 2 to 3% on average. So, and we saw that during the global financial crisis, where depending on which market you're taking, but if you look at the Australian share market, say the ASX 200, it lost around 38% of its value. The ASX 300, I think, lost a bit more. Australian real estate declined by only a couple of percent or thereabouts. So real estate holds up, very well during a crisis. Now, going back to the impact of share portfolios, I think it's important to put some context around those numbers. So when you think about bear markets over 120 years, only 18 times have we experienced that. That's really not too often. So I think the point to make is that they don't happen very often, and when they do, we get out of them pretty quickly. Obviously, it's quite painful when you're going through them, but for a patient long-term investor, which is what most of our clients are, then it's important to kind of look through that. So let's talk about what the returns have been with Australian shares since 1900. So 120 years is a long time. What we can see from the data is that Australian shares delivered 11.5% return per annum. over that period. So $1 invested in 1900 today is worth $482,000. If you're invested more conservatively in, say, cash, if you put $1 in cash, today it's worth $242. Your return was 4.7% per annum. And if you invested in Australian bonds, $1 today is worth $1,017 and your return was 5.9%. So quite a big difference there in terms of returns. Obviously, shares a lot more volatile during that 120-year period. Cash, very little volatility, and bonds also not that much volatility, but more than cash, but not as much as shares. Property over the last 40 years has delivered a return of 9.25% to 10.8% in Melbourne and Sydney, respectively. So in those two major markets, which is where we spend most of our time advising investors in terms of where they should be buying, those have been the returns in those two markets. So also has been very, very good. In terms of a shorter time frame for Australian shares, so if we just look at, say, the last 30 years from 1987, right before the stock market crashed 20% in one day, 30 years from 1987, Australian shares delivered a return just under 9%. And if you go fast forward 1 year from 1988, 30 years on, returns were 9.5%. So you can see there that the returns that Australian shares and Australian property have delivered are almost identical, and both are being growth assets. Now, obviously, within each of those different asset classes, your returns could be quite different. So you need to make sure that you hold good investment grade assets on the real estate side and that you own good investment grade assets within your portfolios. And so this is where getting professional advice is really important. So I hope that's been a little bit helpful, just answering that question just at a very high level. I've got more questions, but I think I'll save those for the next Q&A video, and I'll look to put that together later this week and send that out to you. So wish you and your families the best of health, look after yourselves, and I'll talk to you again shortly. Thank you.